Hello everyone and welcome back to this week's edition of the Do More With Your Money podcast. It's an investment management special again, and I'm delighted to be joined by colleagues from True Potential Portfolios, the management team. We've got Chris Leyland, Faye Graham and George Bell. Welcome everyone. And I'm excited about the topic today, which is going to be a focus on Q3 and in particular how the portfolios performed and how they performed relative to our competitors. Now, one of the reasons we've had to wait so long into this quarter to review the Q3 data is that we have to wait for the data to be compiled and put into a framework. And Chris, this is perhaps where I'll bring you in. That framework for us is ARC. So the obvious question to answer for our clients is, who are ARC?
No, it's a good question. So basically ARC stands for Asset Risk Consultants. So ARC is a company that compile individual investment companies' performance figures. So they do that across 4 different risk categories. And within that, very, very simply for clients, it's a way for them to understand how we are performing versus the wider industry overall. So it's a way for clients to judge us, but actually it's also a way for us to judge ourselves as well.
And when we were thinking about ARC, I guess the obvious question is, was there an alternative there that we could have gone with?
Yeah, I mean, the way that the discussions came about is there were really 3 things that we wanted when we were thinking around a comparator. So the first is that it has to be fair. So what do I mean by that? There's no point having a comparator where the risk levels are not in line. So there's no point having a comparator where it's, say, all equity versus all bonds, because it's not a fair comparison. It's not useful for us. It's not useful for clients. I think the second thing that we wanted is we wanted to be able to address the client's questioning, which is really how are we performing versus the wider industry. And there's so many different ways that you can think about putting comparators together. You can use kind of traditional equity indices, so different industries that providers put together. But for us, what we wanted to do was to look at our peers and within that to understand how we're performing. So when we thought about that, we wanted something that was meaningful. And within that, it meant that it had to be our main competitors that were putting into that survey. And then the final thing when we were looking at a comparator is it really needs to be independent of us. You know, we could have quite easily have put together our own peer groups, but in some ways, quite rightly, clients would have probably been quite suspicious around that. So for me, I want the provider to risk categorize us, risk categorize the other peers, to make sure that everything is done on the same basis, to make sure, again, that is a fair comparison overall. So that's what we were thinking. We looked at different providers overall, but for us, why did we pick ARC? We picked ARC because we felt it was the most representative of the wider investment industry. So there's just under 150 different firms that feed in to the ARC survey. There's a mixture of sort of traditional advice firms, so names such as, say, St James's Place, Quilter, all the UK banks filter in there, so names such as, say, HSBC, and you've got other wealth managers, so names, say, for example, such as Evelyn Partners as well. So for me, I think it gives quite a rounded comparison of how we're doing versus the wider industry overall.
So great. So ARC's clearly independent. It's
absolutely
industry-known brand in terms of their discipline and that oversight they provide and the measurements they provide. So we'll build into how the portfolios have done within the ARC framework as we go along. But George, Q3 seems a lifetime ago for us, given we've had the US election since. So let's perhaps remind people what actually drove those positive returns in Q3 in terms of equities and bonds.
Absolutely. So, the returns were really a function of a very strong market backdrop and also the way in which we build our portfolio models. So in terms of the market backdrop, it was a good environment for international equities that was mainly led by the US stock market, but also emerging markets, and particularly China within there. But it was also a very strong environment for bonds, both government and corporate credit as well. So being in the market was the right decision for an investor, but our portfolio construction our decision on behalf of our clients to allocate a larger proportion of their capital to the managers who have more in equities, and particularly more in the US stock market, was beneficial. Allowed us to generate returns which sit in the top 25% of our peer group when we look at us compared to the ARC industry as well. So that's a good outcome in absolute, but also in relative terms as well, and we can put some numbers around that in a few moments.
So it might be worth, if we think about it, we often speak to clients about the negative correlation we desire between equities and bonds. The idea of one's falling, the other's rising, and it sort of cushions the portfolio such that they rise in a non-volatile way. But in Q3 we had strong returns from equities and bonds, positively correlated. Equities were clearly pricing rising earnings, but what do we think was bonds were pricing such that we got that strong return?
There's a growing concern coming into the market that perhaps the Federal Reserve had left interest rates too high for too long, and we were seeing some signs of a cooling labour market start to come through.
The jobs data for July.
Exactly.
Yep.
And essentially the market started to build an expectation that Federal Reserve need to get moving, and they maybe need to do more than one 0.25% interest rate cut.
And of course they did.
And when that came, and that was the release valve that the market was
Perfect.
looking for. So rather than 0.25% cut, we had a 0.5% cut.
Yep. And it wasn't just, we had a cut from the Bank of England as well, and the ECB followed through with their second cut in September as well. So that's good backdrop on the positivity in markets. It wasn't recession, it was just that perhaps rates were too high, as he said. But Faye, it wasn't just equities and bonds. We were obviously looking for extra diversification of portfolios. Alternatives did well as well.
Yeah, definitely. So, well, George just talked about how strong equities and bonds have been. They returned on a global basis about 6.5%. Gold actually did double that, so 13%. So really, really strong returns from gold. If we think about why that is, well, there's a number of structural reasons, such as emerging market central bank buying, sort of provides a structural demand tailwind for the gold price to continue to rally, and also geopolitical tensions as well. So gold tends to act as a good diversifier and a hedge against market uncertainty. So you tend to see that when geopolitical tensions rise and market uncertainty increases, gold tends to do quite well in that environment.
Perfect. And it's important to reflect that we got this really strong breadth of positive returns from all the asset classes, and they all outperformed cash. So being invested really did benefit those who were in the market. So George, we've kept our viewers waiting long enough. Let's actually get down to some of the numbers. So we've put together here a small presentation for our viewers. Let's focus in on that top table there, which is the performance of the balanced portfolio versus the ARC peer group. And we've given these relative measures going back all the way to inception. So is there anything you want to call out for our clients and viewers?
Yeah, absolutely. Starting point, all of these numbers are after the portfolio charges and after the platform charge as well. So it's a level playing field that we're looking at.
And that's probably something else, which is another key ingredient within the attractiveness of ARC, which is it's after fees.
Yeah, absolutely. If we look in the, it'll be the fourth column along, Q4 23 to 24. What we can see there is the true potential balanced portfolio return 14%. Now that's 3.4% ahead of our industry comparator there. So that puts us in the top quartile in terms of our return outcome, and that's building on outperformance from the previous 12 months as well, which you can see to the column on the right. So 4.7% relative to 3.3% of our competitive industry peer group as well. And this is really building into, a strong track record in absolute terms for our clients, but also relative. And it's the long term which is really important for us. If we look since launch, which is the first column you can see on the slide there, balanced portfolio 55.8% after charges relative to the ARC peer group of 44.3%. So that's an 11.5% outperformance in terms of the way in which we've built our portfolios, our construction, our manager selection, and the tilts which we're taking to those managers and asset classes has driven a performance which is outperforming the industry peer group.
And that's important to bring out, isn't it? It's not just the managers doing the work for us. As an investment team, we develop our own views, which sometimes don't necessarily complement the managers. Sometimes we have to lean into those managers we think will benefit the portfolios most. And that's where the activities and decisions from yourself and Chris, bear fruit, which is some of the managers we lean into actually outperformed over that quarter.
Exactly. And there's a fantastic example of that. If we think back to the discussions we were having early last year, it was much more constructive on the economic backdrop than perhaps some of our managers. Some of our managers were more concerned about the outlook, more concerned that we were going to see a more negative economic growth shock. And our intention was to allocate a greater proportion of clients' capital to equity. So we did that through our managers, and that proved to be the right outcome, and that's been a key contributor to the outperformance that we can see on screen.
It's great. It's really great to see just the outperformance since the inflation shock, through 22, and that all of those losses have been recouped. It's a really strong set of numbers. But let's now focus, Chris, just on how ARC group this for us. So those measures are our relative and absolute numbers, but ARC, of course, do this quartile ranking for us.
Yeah, absolutely. So, you can see the kind of numbers in the top table, and George has very eloquently gone through that. But the other thing that we look at is where do we sit within the ARC peer group, and where you want to sit as a fund manager is what's known as top quartile. What does that mean? Quite simply, it means that you're in the top 25% of the sample overall. So if we just look at the on the screen now, you can see the slide here. And what can you see? Well, for me, the most important time period is actually since launch, because this is the time period where you can see through all the different market events that have happened since October 2015, exactly how we've performed. So if you think of all the things we saw, like quarter 4 2018, Donald Trump versus China, the kind of COVID sell-off, the COVID acceleration, what we saw in 2022, but over the whole of that, we are in the top quartile in respect of our balanced portfolio. And actually what you can't see on the screen is actually that's the same for our other true potential portfolios as well.
So that consistency is across the entire core range, which is top quartile for the last year and since inception for the full portfolio range.
And also through our plus portfolios as well.
Okay, so that's great. Now, you've mentioned that there's a large number of peers and competitors in there. What do we think is driving that top quartile? What is it? What are the decisions that yourself and the team have made which have helped over the long run, which have helped push the numbers where they've gone to?
Yeah, this again kind of builds on what George was saying. So if we think of our positioning, then in general, our positioning is to have more exposure to equity compared to the peer group. So what you've seen is we've got more exposure within company shares, put very simply, compared to that peer group. And that's been very, very helpful. It's been particularly helpful if we look at what's happened over this year. But it's not just that. It's actually how we build the portfolio structurally. Now, when you have looked at fact sheets, you'll see we're not just invested in the UK. We're invested worldwide. The portfolios are genuinely global. And we have more of a global presence compared to the average peer within the ARC peer group. So they tend to have a little bit more UK exposure compared to us. So for me, running a little bit more equity risk, but probably more importantly, the fact that we've chosen to have a more global perspective compared to those peers. They've been the two main reasons why we've seen that outperformance come through.
And of course, that's a really great segue into the decisions you and the team have taken over the last 2 years, which is the view from the team was very positive on global growth, particularly driven by the US. So the roadmap you had developed at the start of last year was add to that global equity presence through adding to US equities. And it was from a manager who was more UK focused and more downbeat on the economy. So we were taking a view which to some extent was juxtaposed with the manager. We were willing to back ourselves and deliver those outcomes.
Yeah.
Absolutely. I mean, if we look through the equity book that we have, and if we look at how we're positioned compared to if you just had an equal weight in each manager, probably the key bet within the equity book is being overweight US equities. And,
brilliant.
And that has been very, very beneficial.
It certainly has. That's great. Now so Chris and George have, in portfolio terms, summarised the numbers. Faye, let's bring you back in. Of course, if we think about balance, there are 10 managers in that portfolio contributing to returns. Now, they mostly all had strong quarters. What would you like to highlight that the managers did over the quarter which helped deliver those returns?
Yeah. If you think about I'll maybe bring out the two top performing managers that we've seen over the quarter, Income Builder and Schroeder. So
very, very different managers, of course.
Exactly, yeah. Really different managers. So Income Builder's a bottom-up manager. So what I mean by that is they're sort of a stock picker. They pick individual securities and also individual bonds as well. Compare that to Schroeder, they're more of a top-down manager approach. Invest in active managers, so very different styles, and also invest in very different areas of the market as well. So Income Builder are kind of in the name. They're an income manager. So they have a focus on generating not just capital return, so price appreciation, but also that income generation as well. So they invest quite a lot in what we call high yield bonds. So they pay a higher coupon, and they benefited from credit spread narrowing over the quarter.
So but basically investors were willing to pay more to own corporate credit bonds than they were government bonds, and you saw that credit spread tightening, as you say.
Yeah, exactly. So that was really beneficial for Income Builder. And then the other aspect as well that I think really benefited them was sterling strength as well. So they hedge, I think it's about 100% back, fully hedged back to sterling. So they have quite a high sterling weight. And you saw sterling strengthen about 5.5% against the dollar over the quarter. So that was another. So
somewhat bizarrely,
tailwind.
for viewers to understand, being hedged or insulated against that sterling strength actually protected the returns they would otherwise have had when booking those returns in sterling.
Exactly.
In sterling from abroad.
Exactly,
Perfect.
yeah.
But you mentioned, so that's Income Builder, income focused through bonds, hedged. One manager we know that you've referenced who doesn't really take many positions in bonds is Schroders, but they also were a top performer.
Yeah, so as I say, very different manager. One thing that really, I touched on before, that they invest in that really helped was gold. So they have a lot of exposure to gold. I think it's about 10%. And they actually get most of that through gold miners as opposed to the gold metal. I mentioned that return for gold before, 13%, was really, really strong. But you actually saw gold miners outperform that on top as well. So that was a really strong driver.
So that's terrific context, really. The one thing I've taken away from this is that advanced diversification continues to work for our clients. It's delivered a strong set of outcomes for the portfolios. This builds on the podcast we all did on a similar theme for Q2 numbers just a few weeks ago. And that's all for today, ladies and gentlemen. Just a full review of Q3 and help you understand how the portfolios are working for you. We hope the input from colleagues has given you the context on the decisions made and how they are working for you. We're delighted to report the success of the portfolios here. So please do like and subscribe on the YouTube channel. Please do tune in to our Week in Markets review if you can, where we'll focus in on the UK. And I think it does provide context for why sometimes being focused more on global growth outcomes rather than the UK benefits your portfolios. So that's all. Thank you and take care.
This video is not a recommendation or personal financial advice. With investing, your capital is at risk. Investments can fluctuate in value and you may get back less than you invest.